friends, welcome to Nirmal. I'm Piyush Jain, and today we are going to be understanding the economy, the broader macro outlook on which the stock market works, and a lot of factors influencing the broader earnings environment. Today we are going to understand that. Of late, we have seen a couple of macroeconomic numbers being announced. We actually saw inflation numbers. We have also actually seen the GDP numbers, the GVA numbers. A monsoon has ended. What this implies for the agricultural growth, the broader growth environment. Remember, all of this, it goes into the calculation of RBI also. So monetary policy is also something which we'll try and understand how perhaps over the next couple of months, how those factors could be looking like, and how perhaps all of these actually could be tying down for the markets itself. Let's try and understand the broader macro environment, and for that, let me welcome a veteran in this field who has been studying macro environment, Mr. Andril Pan, the Chief Economist of Yes Bank. Sir, welcome to the show.
Thank you very much for having me over.
So let's start with the numbers which we actually have seen. The GBA numbers, GDP numbers were quite cheerful, enthusiastic. I think if I would say like that. I was looking at the GBA numbers, almost 4 quarter high. Real GDP numbers, solid or almost 8% growth. YY between that, perhaps a strength on the capital formation. But broadly, how do you read these numbers, both from the perspective of uh, the strength of the underlying growth and also from the perspective of the spread of growth?
Okay, I think this is a very interesting question at this point in time, and contextually, I think the Reserve Bank has been quite sort of holding on to their 6.5% GDP projection with an understanding that growth is resilient in India. That's number one. Number two, the positivity also comes from the fact the IMF has upped its growth forecast by about 40 basis points from its previous number of a 5.9 to a 6.3. So most of the numbers of the economists are ranging between, say, a 5.8 to a 6.3 or a 6.4, which definitely makes India one of the faster growing economies of the world. Now, having said that, I think the other factor that needs to be understood very carefully is that the critical strength comes from, even today, comes from the government expenditures. And private sector expenditures in terms of the capital formation has not really picked up. We have been hoping for it to pick up for a long period of time, given the fact that balance sheets, both at the lenders level and the borrowers level, are relatively much better than any of the many years that we have seen before. And there is definitely a hope that private sector will also come and invest. Having said that, I think the critical problem that the private sector faces, even at a 73, 74% capacity utilization level from an industry perspective, is that the outlook on the demand or the outlook on consumption spending is still quite weak. So very clearly, I think the urban segment is actually spending, and the growth in the urban area is relatively healthy. The rural segment is in a sideways momentum. We have been hoping for the rural demand to pick up, but that has not really picked up. One of the critical reasons, of course, is the monsoons, which has played truant. The monsoons are lesser than the long period average this year, and also the spread of the monsoon has not been good enough. And very, very importantly, I think the expectations from the Rabi crop could also be a shade lower because reservoir levels have suffered due to the truant monsoon.
So this is a very important point because when you're saying that, does it imply that this perhaps could lead to any sort of prolonged lower rural consumption as we move towards the third and the fourth quarter of the financial year? And secondly, does it also imply that actually there is a risk of higher inflation in the food prices also? Like for a layman, for our viewers, perhaps those could be an immediate pertinent question.
I think the rural consumption may suffer for an extended period. also because of the fact that the rural wage growth, both from the agriculture and the non-agriculture, is just about 6.5% average. Now, with an average inflation of 5.4, which is the RBI's projection for the year, the delta or the real income growth for the agriculture sector has been weak. And on top of that, we have had a relatively sort of bad monsoons, and that is likely to affect agriculture. Now, the problem is in India because of the smaller land holdings, the marketable surplus is not very significant, which means that if a certain farmer is cropping X, he anyways has to go to the market to buy Y and Z. And because of the elevated food prices, especially cereals, pulses, vegetables, we had a problem. Now, of course, it has cooled down. Spices is on the higher side. So all that affects the real purchasing power of the consumer in the rural areas. And that is something that we might actually see a bit of a struggle continuing going forward. Now, if I purely again take the instance of tomatoes, prices did go up by 175%. But again, 2 months later, we had an incident where excess tomato cultivation was dumped on the streets in the critical state of Karnataka. So the answer lies in maybe the logistics and how we can sort of build up storage capacities for the perishables. We are not maybe too worse off in terms of non-perishables. We still have adequate buffers in the FCI in terms of rice. Wheat may be a bit of a problem because we had distributed wheat in a very significant way during the COVID period. So wheat demand versus supply is running neck to neck, but we are still comfortable on the rice. Where also we need to be careful because the El Nino has affected rice cultivation across the world, and that's the reason why the Indian government has provided for a stoppage in terms of the rice exports so that we don't ourselves land up in a shortage. So it's a mixture of a lot of things that we need to look at when we need to understand both inflation and the growth perspectives, and more importantly, how the growth is distributed across the population.
My next question was coming on that only because I was looking at the gross fixed capital formation numbers here, and that was showing a growth of 8% YOY. As perhaps gross fixed capital formation sometimes basically is, we also look from the perspective whether the investment actually are picking up. Help us understand when we say that the private capital investment is not picking up, how important this GCF number, from where this consistent sort of growth numbers are coming quarter after quarter, and perhaps how it's going to look like as we move ahead.
I think the most critical element in the gross fixed capital formation at this point in time is the government expenditure. Now, the data that you are referring to is of the first quarter of the current financial year, which is April, May, and June. And budget numbers also do indicate a very strong build-up in capital expenditures. So, what could have been also happening is that because we are headed into an election period, the expenditures of the government are expected to be relatively slower in the Q4. In most of the other years, the Q3 and Q4 expenditures pick up, but in this year, possibly the government has forefronted the expenditures with a clear understanding that the Q3 and the Q4, as we head into the election period, could be a lower capital expenditure. So that is pulling up the gross fixed capital formation numbers in a very significant way. On the industrial side, uh, I think there are pockets where investments are happening, such as the steel, the pharma, the infrastructure related companies, so to say, the cement, where capacity utilizations can be quite high. But there are other segments where, which is basically, say, the FMCG companies, where because of the rural demand being on a relatively short sort of supply, short in terms of the expectations, the rural demand, the capacity buildup is clearly not happening. So I think that's the bottleneck that we need to tend to sort out. And given also the fact that the external demand atmosphere is weak, as we are expecting the global growth to also relatively weaken, that's, I think, the critical problem for certain companies who are clearly catering to the consumption segment.
Right. And that's why actually I was thinking that when you take a look at the export market, and if you take a look down at our numbers, it is largely just showing that the current account deficit in first quarter of FY24 it widened. When we actually take a look in from the perspective of capital account surplus, that basically has improved largely from the perspective of FPI flows. So, what do you make out, especially when now we're talking about more wars, another war actually coming out in the Middle East. There's already a Russia war which is happening. Um, what's the strength of exports right now? How are you looking at the CAD? Because again, then we go back to how the sort of perhaps currency actually is going to sort of shape out from the way actually global markets actually shape up. So, how's this overall equation looking to you?
Okay, I think as the recent numbers, even on the trade side, going beyond the balance of payments numbers, which is the quarter one number, I think the non-oil, non-gold imports have held up. Though the last month we did see a fall in the non-oil, non-gold imports, it's very difficult to take one single number to highlight that we are also in a weakening phase. But overall, if I look at the situation, the non-oil, non-gold imports have been relatively resilient. It has been the exports which have been on the lower side. Now, if I really take the critical sort of markets for India, which still is the US and the Europe. So the US, Europe, and the UK together, if I'm not mistaken, make up about 35 to 36% of the total exports for India. But those are the economies. The advanced world is relatively advanced economies are relatively expected to slow down as we head in the later half of the later part of the calendar year and also in the beginning of the next calendar year. So there is a worry in terms of exports over there. You did refer to the Middle East. Now, our understanding at this point in time, of course, it's a huge black swan event, but our understanding at this point in time is that it is unlikely to escalate into a war situation which incorporates even Iran. And that could be a severe sort of disturbing factor for India's export because Middle East takes about 16% of India's exports also. So this is an area which we think at this point in time may not be a big cause of worry, but we'll have to watch this space out. And if there is a larger sort of indication that other countries, which typically is Iran, who is joining the war, then I think we can have a relatively more disastrous situation for India's exports. On the balance of payment and on the currency, I think something very interesting comes out in the sense that for the year as a whole, we are expecting about 28 to 30 billion in terms of the balance of payment surplus. Having said that, if you look at the Q1 balance of payments numbers, it already has covered up 24.4 billion. So the room that we have in terms of accretion is relatively quite low at about 6 billion. And which is also very clearly being sort of seen today, whereby the RBI is more a seller of the currency rather than a buyer of the currency, so as to manage the currency market fluctuations. So that's important in the and therefore I think the clear message that I want to draw from here on is that we should look at the currency more from a depreciating perspective than an appreciating perspective. FPIs had been strong in the Q1, but we have seen some softness happening in Q2. FDI is a relatively low number at 5 billion in Q1, and we are definitely not going to see the 35 and the 40 billion that we had seen 2 months back, 2 years back, and even the 28 billion that we saw in the last financial year may be brought into question. So there are risks that can actually play out on the balance of payments more from the capital account side than the current account side.
Right. And one small doubt. I wanted to ask you that usually if an economy is doing well, sometimes you also take a look at imports in that positive light, that if the imports are growing, are resilient, and if the sort of consumption growth or basically a broader GDP growth is looking good, then basically it is a sort of positive sort of information. Is that something which holds relevance right now, or like are you reading the non-oil, non-gold imports from that perspective?
So obviously, yes. I think the point that I was trying to mention is that the stability or the relative resilience of the non-oil, non-gold imports is the very fact that the domestic consumption relatively is
Remains
strong,
strong.
and
Hmm.
definitely stronger than the external demand atmosphere, which is playing out in the lower export growth that we see. So
So, sir,
that I think, yeah. Sorry.
just jumping in between, and now if we're looking at perhaps over the next 2 weeks, whatever has happened, where there has been spike in oil energy prices again, um, m- maybe we still perhaps don't know whether it's going to get reflected fully in the pump prices, but there has been spike in energy prices. We have also seen a marginal but some spike in the gold prices also. Is it something which perhaps you fear that perhaps that could actually play some spoil sport, or is it too early to say?
Well, I think energy prices, as per our expectation, and as I said, that we are not really expecting the Mid East crisis to take a full bloom war scenario, which can actually, if I look at most of the commodity research that is coming out, is looking at oil at 100 or even higher. So that's not the scenario that we have factored in at this point in time. Our expectation is for oil prices broadly being within the 85, sort of an average for the year as a whole from here on, which is also the expectation from the Reserve Bank of India. So
And
at 85.
also the perhaps an election year, so maybe the pump prices don't change that much.
So I'm pretty sure that the pump prices don't change, won't change, and the government will sort of hold on to the pump prices for the moment. But I think the critical issue is that because the pump prices are not changing, the higher crude is definitely not bothering you in terms of the retail inflation, which is a positive from an RBI's perspective, and therefore oil related further tightening of a policy from Reserve Bank of India is not warranted. That's a positive. But having said that, the very fact that the pump prices are not being changed can also lead to a bit of a worry on the fiscal side.
That's good
So that's
definition, yes.
something that we need to watch out for. Oil prices being higher also means that the fertilizer prices remain elevated, which means
Yes,
that the 1 trillion of fertilizer subsidies that the government have budgeted for the year
good
may
increase.
be actually higher. We get indications whereby the fertilizer subsidies may be about 50,000 crores higher. So these are some of the noises that can play through from the fiscal side, and the indirect impact it can have on the CPI through the WPI, because a lot of companies who actually are looking at commodity imports and oil imports and using oil and oil derivatives for their production purpose may see input cost prices going up. Added to that is, of course, the expectation of the currency depreciation, which can add a little bit of pressure on the input side, which can be passed on to the consumers.
Right, and I was perhaps drawing one fact that if the bias, as you just stated, it is towards currency depreciation, perhaps for markets also, those dollar stocks or dollar sectors where actually earnings are denominated in dollars, that perhaps actually could be a factor which everybody should keep in mind. But having said that, let me ask your view on the CPI trend. We saw some sort of mild, cheerful numbers, vegetable prices going down as expected, CPI numbers looking more comfortable, perhaps giving some reason that maybe RBI doesn't have to really think about any rate hikes. What's your internal view? Are we like looking for some status quo for some time?
So the surprise element on the headline CPI was definitely the tomatoes, which played out in July, and headline CPI jumped to 7.44. Then headline CPI came down to 6.8%, and now we are back in the broad band of 2 to 6%. And it will continue to be there around the 5-ish level is the opinion that we have in terms of our model. Now, the critical element here is that in the last two monetary policies, the RBI has clearly articulated the fact that they are no longer happy with inflation below the 6% line. They would be now more looking at a durable reduction in the headline inflation towards the 4%. And our model definitely shows that the 4% could remain elusive, which necessarily means that we should not be looking at any reduction in interest rates from the Reserve Bank of India, their repo rate, I mean. On the other hand, we don't expect the RBI to even raise the repo rate because inflation, especially the core, is providing a lot of comfort. The core prices are coming down. Last month's reading, we saw a 4.2%, and it can actually go down to a 3.8 to 3.9 as we end the year. The RBI clearly contends that the previous rounds of interest rate increases are yet to fully get factored into the lending costs. So that's something which will continue to be a negative for demand in the economy, and then the core prices can continue to come down. The critical worry, of course, remains in terms of the pulses prices, where we had a relatively poor acreage during the southwest west monsoons. The other worry is pulses is more critically a rabi crop, and if rabi because of the lower reservoir levels, if
Water
rabi also
levels.
fails,
Hmm.
then pulses can be a problem. But if I go back to the trade data, it clearly shows that the pulses imports have been increasing over the last couple of months. So the point that I'm trying to make is that the government is almost getting ready for an eventual situation, possibly, that they would be releasing pulses to cool pulses prices if we were to be in a very nervous zone in terms of the pulses. And that's the reason why pulses imports have been increasing. So stockpiling of pulses from a government's perspective is clearly on.
Makes sense, sir. And from that perspective, what do you expect out of the government bond yields, overall liquidity? How are you assessing that?
I think the government bond deals very clearly had foxed economists and markets alike. And the expectation and the hope was that because of the bond inclusion and relatively steady inflation in India, with no chances and expectations being factored in of another repo rate hike, bond yields were trading at the 7-10 levels, and they were hopes that it will go down to even a sub 7 level because of the bond inclusion. However, I think the clear sort of message from the RBI that came out in the last policy was that they will not shy away from using tools like open market operations, more in terms of sales of the government bonds. If liquidity turns out to be more than adequate in terms of the RBI's own prescription, and that has spooked the markets in a very significant way. So I think the clear indication and the intention maybe of the Reserve Bank of India is to correct for the very low difference that the India bond yields have against the US bond yields, and they are looking at a bit of a steeper yield curve in the Indian context. So I think the supplies on the other side is not a worry, in the sense that in the second half of the financial year, we are looking at net supplies only at around 3.5 trillion, and that should be easily taken care of by the market. The RBI's open mouth operation, so to say, of an OMO has created the problem, and therefore I think the bond yield should remain in a 725 to a 745 zone for the remaining part of the financial year.
Point noted. So looks like status quo on the RBI policy. Yields perhaps could remain resilient, as you're saying, 7.25 to 7.4. From the perspective of inflation, core CPI looking better on a declining trend. And then also we talked about the import trends, they actually remaining resilient. So if I sum up everything and we actually move towards the conclusion of our conversation, the current trend towards the third and the fourth quarter, are you like slightly on an optimistic note, neutral note? How should I actually see that?
Uh, I think it's a very challenging scenario for the policymakers, no doubt. Second half of the financial year is likely to be slower in terms of growth. So that's
Okay.
something that is a challenge. There are indications building up from a stock market perspective that the very healthy balance sheet numbers may actually be seen to be eroding. Indication and forward guidance from IT companies are not too solid enough. So I think
Hmm.
it would be more of a cautious optimism, given the fact that we can't be as bad as the advanced economies, but the upside remains a bit of a challenge at this point in time.
Very important point. So I think we'll take that as a sort of a cautious optimism, and perhaps that will take home with that. But sir, as always, thanks a lot for coming on the show and giving us a very in-depth outlook and also in-depth assessment of the existing macro conditions.
Thank you very much.
And dear viewers, I hope you enjoyed the show. You learned a lot about what's the current macro environment looking like. For now, it's a wrap on this conversation.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.